Good afternoon, guys. Welcome back. This segment is literally a talk show, and what we're doing is getting our absolute subject matter experts to talk to us, Q&A, pulling it all together, and we're very, very fortunate. And this segment we're calling Vector's Voices. Vector will have a voice. This is part of its positioning, part of its brand, that they talk to some of the best people in the marketplace.
So I'm Anton Hobeika. I head MENA Research Partners. So we are active in research and consultancy. We do market, sector and financial research for our clients, being financials or non-financials. So to be brief. So in this session, what we want to be is, so maybe most of you or many of you would have like some more background of what are in general the GCC long-term trends in terms of investments and economics. But we want to show here is what's our own view based on our presence in the market, our interaction with our clients, where we see opportunities for the next decade, where we stand on the short, longer run today, and where we are heading to in the next 10 years or so. So what we see today at GCC, unlike previous cycles, governments are unleashing their long-term potential. Things might be happening on a fast way sometimes. In other domains more slowly, but things are changing here and opportunities are arising as we go. So if you take the long-term GCC potential, how big really is the opportunity for private sector here, and what is really the need in terms of smart capital for growth in the next years to come? Where we come from, the ground zero is we're coming from a let's say decade marked by a oil slump, where we went from $100 oil levels to around the 60s, and these 60s levels are here to stay for the next decade or so. This slump in oil prices, especially that the GCC have been always betting on oil recoveries, on oil price recoveries to stimulate their own economies. So all stuff that happened during the past years had brought in spillover effects on government finances as well as economics. But where we see, based on long-term visions of the governments, which might be reaching their own targets or not, but based on what we see in the market, based on the long-term visions, based on unleashing sustainable growth in the market here, we see that the private sector opportunity for the next 10 years is roughly at around $570 billion, coupled with the large funding gap from especially corporate, especially private sector, roughly at around $1.7 trillion. From where did we get these numbers? If we take today GDP on the GCC level, we sit at around $1.5 trillion in terms of GDP, out of which only less than $1 trillion is from private sector. However, if we account for the next 10 years, only for a 5% nominal growth, which is on the conservative side, accounting for around 2.5% in terms of real growth and 2.5% in terms of inflation. So having 5% nominal growth, this will add to the GDP at around $2.92 billion. If you couple it with a shift from public to private sector of only 10% the region here, which is more on the conservative side, you're going to add up around $275 billion of GDP, which is based on economic growth and coupling it with long-term visions of increasing private sector role in the region here. We are talking about 570 billion of economic opportunity in the region. How much of it can be tapped by private sector? How much will it happen? That's yet to see. But this is the potential that we see on the conservative way in the region here. You couple it to it, not only private sector will have a market opportunity, but also from where will this funding come? Today, if you compare how the GCC is being funded compared to other emerging markets and global markets, you will see that if you add up funding from public markets, being it equity or debt, add to it bank lending, you see that today these fundings, being public markets or loans, add up to around 140% of GDP in the region. If you compare it to average in the emerging markets or even in global markets, at these levels, the funding, let's say regional corporates are hugely underfunded. If you compare it only to emerging markets, there is 1.7 trillion of funding gap. If you compare it one-to-one to emerging market piece. If you compare it to more global ones, being it US, Euro, Europe area, this 1.7 trillion goes to at least $4 trillion. To say that, not only we think there is a huge gap in funding, but this funding gap can reach hundreds of billions of dollars. Who's gonna fund these? It is definitely private investment companies. Private capital, there is a large call for private capital to come in and fund this growth. So how things are happening and why we see that this need is imminent, at least during the next 10 years. Where we come from is ground zero. Oil prices have come from $100 to $60. Governments have taken the strategic decision today to do an economic transformation, which is in two waves. First wave is short-term fiscal measures, which target is to minimize cost and unlock large part of revenues, and two, to have long-term transformation plans being put in action. This transformation plan aims to unlock the sustainable growth in the region here. So what we have today is a shift from the short-term pain, which we have seen as marked economic slowdown in the region here, to what we call resetting economic fundamentals and unlocking the long-term gain of these economies. So we are not painting an opportunistic picture here, but what we are saying is an opportunity to consider MENA. If it's your global investor, consider MENA. MENA is not on the allocation heat map of global investors, but opportunistically, MENA needs to be considered and actively. So what we see is recovery in the making. It's a very slow recovery, but it's happening as we talk. And where we see early signs, the restructuring is gradually paying off in different countries, being especially in the GCC like Saudi, like UAE, etc. So with this transformation, new sectors are growing. We see different types of economic sector themes, which we're going to expand on. Few of them are like shift from oil to renewables, shift from cycles to defensive sectors, riding the digital waves. Fundamentals are here, demographics, millennials, high growth demographics, a huge expat base depending on the geographies, etc. The region here is extremely positioned as a regional, even global business hub, so attracting businesses, base yourself here, serve the world, etc. So where we are today is we are transiting from an austerity period towards long-term sustainability. So where are we really in this shift? Where what we see is definitely GCC is a turning point today. We see like 20 years worth of changes is happening now, to be compressed in a few years of transformation. We are definitely transiting from short-term headwinds towards long-term transformation, and growth is gradually forging, especially the GCC maintains a low risk framework as compared to other peer emerging markets. So the realities, what we see here, if you take at least during the last 2 decades, you see that the long-term trend is towards lower growth. So yes, GCC is gradually have been growing lower, especially most of the economies here, especially if we talk Saudi, UAE, Kuwait, etc., who are highly exposed to oil. We are highly exposed to oil fluctuations, and this has been definitely impacting your long-term capability. But what we see today is the strategic decision to go and consider oil. We will not anymore base ourselves on oil to grow, but we're going to use oil as a breather to promote our long-term transformation. So use oil as a breather and not oil as a base to relaunch our economies. If you take since like 20 years now, if you compare non-oil growth to oil growth, you see that diversification has been happening in the region here. Okay, not very fast as needed, yes, but definitely growth has been happening. And if you compare during the last 20 years, and that's how long-term investors will look at it, if you compare oil to non-oil, yes, maybe we've been growing on a GDP level at 3, 4, 5%. But if you take out the oil from the equation, the non-oil have been growing at around 6.4%, which is extremely comparative to what we see in Asia. Today, yes, we're having so the question here, why are we growing today at 2, 3, 4% in terms of non-oil if this is the average? And we're going to answer this as we go. So to say that with the shift in economics, definitely there is a shift in mindset how to invest. Consider defensive sectors. These are the ones who can resist cycles, etc. And governments are promoting these sectors. Capital market-wise, we see that investor sentiment is enhancing. More stability is coming back to the market. Gains are not yet there, but definitely stability and volatilities are going down. From a risk perspective, backing that we are going into long-term growth, I'm going to see how. From a risk perspective, the GCC is one of the most attractive within emerging markets in terms of risk. If you take what rating agencies are showing, most of your countries are rated better than many peer markets. If you take in terms, for example, in one of the risks like forex reserves, 45%, your reserves account to 45% of GDP as compared to lowest rates globally. So definitely we have a business-friendly market economy coupled with a large financial power to counter or to absorb cyclicalities, at least over the short to medium term. So foreign direct investments have been evolving. If you take a long-term view rather than annual fluctuations, growth is there. Yet growth can be plateauing recently, but definitely if you take a long-term view, things have been changing, and many cities have been promoted as business-friendly cities. And if you take ranks like, for example, in global competitive index, and yet which are the entities to consider here, sub-entities within it, bearing in mind this, most of the countries have been doing lots of efforts to promote their ecosystems. And yet, as we said before, the economic opportunity will be accounted for by the private sector as we go. There is a strategic shift from having the economic burden taken by the government. The trend in the market is to shift this economic burden toward the private sector, especially in many sectors where private initiatives will be banked on. So we're gonna be very fast here. So how really fast are we, or where are we in this long-term transformation? During the past few years, we have gone through an austerity period, and that's have been weighing negatively on economics. One, many governments have been introducing new taxes, which definitely limits the potential for growth as we go, limiting costs, waving down unnecessary spendings, etc., which have counter-cyclical effect or negative effect on growth, which have been pushing growth down to the downside, or holding it to the downside, at least over the short term, as your fiscal adjustment has been happening, which have undermining long-term growth. But in parallel, most of the GCC governments have been launching long-term transformational plans, being it on the national level like ASA UAE, or on the federal, on the emirate level like in Abu Dhabi, Dubai, etc. So definitely change has been happening, and fortunately governments have the financial power to implement these and take the burden of transiting towards the long-term sustainability. They have accumulated large set of reserves, they have large SWF asset pool, and they have a large gearing potential. So short-term measures, we have been reducing costs, increasing revenues, etc. Long-term plans have been everywhere, being in Saudi Arabia, being in UAE, Abu Dhabi, and other plans. And now you're using more and more the oil revenues, not anymore to promote growth, but to speed up your transformation. That's why you've seen this in Abu Dhabi, especially more than 50 billion is coming, yet is coming to injecting liquidity to pay back contractors, etc. But the idea is injecting liquidity and using oil always now to just speed up your change. What are the tools? So as we say, okay, we're saying, okay, short-term pain, long-term gain. But what is really the potential for the region here, or for the governments to promote this or to entrench this transformation? Today, based on the financial cushion we have at least 60 years potential of resources to sustain our economies and implement the long-term plans. Being it, if you sum up sovereign wealth funds, which is at around $3 trillion, you add up your gearing potential based on what your today leverage is compared to emerging markets. You can additionally go and on the markets and raise funds from leverage perspective at 0.4 trillion. You add it up. When you add up this your financial cushion, and you compare it to your current budget deficit, which was at $55 billion 18, which is less now, you have at least 60 years potential resources to go and sustain your economies as you promote or you entrench your long-term transformation. Okay, so this change is extremely important, and this is happening. Oil is here to stay at $50. Most of the countries will incur the deficit until they entrench change. They have the financial cushion. Most of them, or most of the GCC countries, have amassed 1.1 trillion of fiscal surplus during the past years, which is large sum to be able to recycle, and they have been recycling into their economics. Sovereign wealth funds, we have one of the largest sovereign wealth fund growth. So we have the financial cushion to go and promote our economies, especially also when you compare that to GDP. We are definitely on the lower end of our cycle. Okay, so in an era where share oil is rising, renewables, adoption of electric cars, so we have a demand destruction for oil. So oil at $100 will never come back, and if it will come back, it's gonna be like just for brief. So then the $60 oil is the new 100 that all GCC governments will need to cope with, and that's why restructuring needs to happen, and this strategic decision have been taken. So what are the investment opportunities? I'm showing that no more time here, so I'm not going to spend much on the opportunities, which are the most important here. But we're going to show what would be like most top 8 trends, investment trends in the region here. One strategic theme is there is a shift from oil to renewables. Especially if you take Saudi Arabia in their 2032 plan, they have a target to have their own power generated 50% with renewables. The largest oil producer globally has a target to generate electricity 50% from renewables. So that's one strategic theme to bank on. Two, there is a strategic shift of the economic/social burden from governments to private sector. Education, healthcare are two great topics which is driving which attracts the investor interest. Three, there is a rise in new sectors, entertainment, logistics, in addition to technology. So no company today can resist embracing technology. Technology is disrupting every single business. You cannot resist, you need to embrace technology and need to adapt this to this new reality. So if we consider traditional sectors, merit still exists in traditional sectors, big industrials, real estate in some sub-segments, chemicals, etc. There is interest in traditional sectors, but this interest should be extremely targeted. Environmental considerations are growing, efficiency, sewage, etc. All these have opportunities for private sector. Lastly, one trend here we see, okay, guys, come and as a global investors, base yourself in the GCC. But how big really is the market locally? How much really it's scalable to have global investors to come and position themselves in GCC? One way to see it is base yourself in the region here, but turn your national champions, homegrown brands into global champions. Bank on the export, bank on the geographic location, etc. These are trends that are clearly seen, especially with government-owned brands. 8, lastly, is privatization. This topic has been lacking for years and years and years, but this we see an increasing potential here. There are around 600 candidates, government-owned candidates for privatization in the market here, and definitely, as governments will consume their financial cushion, privatization will be one key topic here. So we can develop on each one in the following slides. But if we
I think this is a great slide to end and open up to a few questions. I'll come across there. You heard a very, very interesting snapshot. Was this a surprise to people? No, really?
My surprise is that it has a more positive tone than what I feel when I go out on the street.
Yes. No, I think that is one of the things I wanted to, because he's taking a macro view, longer term perspective, and then the glitches are being smoothed out. I think that's an interesting perspective. You think it's this is reflecting what the market is?
Okay, sure. Okay, look, we interact a lot with clients, okay, and most of our clients are within education, healthcare, construction, etc.
Yeah.
What we see definitely, change is very slow. So we're not showing definitely what I said at the start. We are not painting an optimistic view, but we see the potential is there, and governments are working in promoting this potential. Now, definitely, change, regulation, all this stuff take time to show. The results will take time to show, but definitely, it's what we call an early mover in the market here. Okay, you need to be at the right time, targeting the right sectors, partnering with the right partner on the ground, etc.
My second question is, if we accept that there is this concerted effort by the countries to change and to promote these long-term visions with new plans and new priorities, recognizing the shift in oil prices, etc., how does this engage with political, regional political security realities?
Sure. So when you take into account this economic view, definitely you have the political / social / so local politics and regional geopolitics that definitely will take their toll on it, and that's why global investors don't take MENA as a strategic allocation, but they consider it on opportunistic level. So it's here definitely weathering your economic potential to political risks, and political risks exist here. Okay. Now, if you take from historical perspective, I mean, GCC has been one of the most stable countries in absorbing shocks. From a strategic perspective, given oil and the likes of oil, okay. So strategically speaking and historically speaking, I mean, stability has been there, but definitely you can never rule out any political risk from this equation.
Another thing which I found fascinating in here is that the private sector, the deficit that you sort of see there, is it coming from family groups? Is it coming from capital markets? How do you see that?
Definitely, private sector. I mean, one key component of private sector is our family groups, and you have estimates showing that family groups account to 90%, more or less 90% of your assets in the GCC region. So family groups are definitely one of the key components. And we have done a research for a large family group here, and have done like a large research on the potential for family offices here, etc., etc. So yeah, the opportunity is in trillions.
Can you give us a couple of examples of national champions to global leaders? Are we talking about SABIC? Are we talking about people like that, or?
Yeah, so we're talking about like you have from the private and public sectors. What is it? So definitely you have many public-owned companies. Also you have like privately owned companies from public markets, private market, etc.
Right. Okay. A few questions. Yeah, please, Jody.
Yeah, one of the questions is from my side. I don't think I need that. I think everyone can hear me. We looked at PMI indexes and worked quite closely with HSBC senior economics advisors as well. This region never likes to hear negative news anyway.
Right.
So how much of this is the positive spin that a lot of the data within the region likes to show? PMI index was always at 53, 58, but that was the lowest it's ever been since kind of PMI started to come in. So my first question really is about the validity of the data, right, in the expectation of that kind of growth rate. The second question comes into it, oil, right? Take the oil part out for a second, but when we start looking at GDP growth of organisations that don't have some form of government involvement, and they are completely separated from government, what are you seeing there? Because having worked at OSN, we always knew that we were competing against the government. It didn't matter what Etisalat could say GDP growth was going to be, or their subscriber base was going to lead to GDP. We knew that we were fighting government, right? And that was a big issue. And my third question, if you don't mind, is where is the talent going to come from in order to support the growth that you're starting to see?
Sure. So first question on the PMI stuff. Definitely there is lack of data and lack of transparency, and that's one of the key deficiencies in the region here. So you don't have really data. So that's why private initiatives come and try to fill it. But bearing this in mind, definitely the negative part, there would be no announcement about negative side. But if you take really official data, it shows some, not negative tone, but definitely not this rosy picture. If you take, for example, Abu Dhabi, they just announced like a few weeks ago, like non-oil GDP grown 1.3%, during the last few quarters. So that's not a really rosy picture. But what we see here is the negative. It's not really a negative part, but it's really balancing between the short-term dynamics and more long-term transformation. What I've seen during the last few years, these austerity measures, etc., these are counter-cyclical for sure, and these hit on your growth. So when you see that, we have still limited or let's say a sustained growth, we are coming from an austerity period. That is that's one. Two, no, three. The two what was?
Yeah, the second one was about kind of government.
So this trend differs from a country to a country and from emirate to an emirate. Okay, but definitely, I mean, governments have been entrenched in this region here. All growth, if you take Abu Dhabi for example, has been coming a lot from government, either purely government-owned companies, a government as a government, or government-owned or related companies. That's for sure. Okay, but definitely we are seeing more and more a certain transition toward these. Now you have some sectors which are definitely dominated by governments. If you take telecoms, but you take lots of sectors, other sectors. You take healthcare, you take education, you take logistics. You see lots of private there. So to go from a purely government-driven economy to a privately driven economy, that's a long term. That's a long term stuff. But we see change coming. It's very slow in sectors, more rapid in others, yeah, given the strategic aspect of these assets. But if change is coming. Now for talent, get here, it depends. If you take Saudi and you take UAE, if you take UAE, it's more expat oriented, more expat driven. So it's more of rising like Dubai, Abu Dhabi as attraction to expats. If you take Saudi, it's more on the local side. That's the Saudization part, enhancing education, uplifting skills, training, which is a long-term local. So we see really different countries in different aspects.
Celeste, quick question.
Which impacts your cost at the end as a company.
Very quick question. Thank you very much. Since sovereign fund, it's my area of expertise. So
Louder, please.
sorry. You mentioned about sovereign funds as potential cushion for the economy. But actually, my view on sovereign funds that they are much more liability are becoming explicit. And we see here, right, that they are investing in development, and they change. And decide they want it by mandate, they need to invest abroad. So just quickly, as a big investor, you can translate which is the relationship.
Right.
Because I don't see
Sure.
such a clear relationship.
Yeah, sure. So sure. So how much of the trillions you can use today? So what you say when you say 3 trillion, you go into a stress test. Okay. When you say if I want to stress test my economics, and I liquidate all my assets, if I can liquidate them, you have a cushion. Okay. Now this cushion, how does it translate on a daily basis? It's from the income that the cash that these companies or these assets will flow in. You know, either be it companies or public stocks investments. You know how much really they are yielding revenues for you. So really when you do stress test, you know that's where you see the cushion. So it's not like an asset or a liquidity that you can use tomorrow. You know, which
sorry.
Yeah.
One final question. Sorry,
which you will never have an oil dropping to zero to $15, $20 with zero revenues on the side, etc. You know.
My only concern, if I can share it, is that in the future they will be like the Norwegian sovereign funds look at the pension. You will have a VAT system, you will have a fiscal burden, so you will use the sovereign funds also besides stabilization and future generation for the fiscal burden, for the development. So as an investor, I don't feel that they really will use their asset under management as an injection in the economy. I agree with you that
so stress testing, last resort.
Okay.
Yeah.
One final
last
question
resort.
with a view to Vector as a company, as a consulting, a boutique consulting firm, and we were talking about building it into a platform today. From your perspective, what do you see? Is there a question from a pure macroeconomic and opportunity perspective that you see, you know, like family companies? What kind of groups? Is there one final question that you'd like to ask Anthony? Anybody? Which really reflects much more of your business strategy.
Maybe what do you see? What's needed for the companies from this region to conquer the world?
Sure.
What's needed most?
First, before they conquer the world, they need to transform themselves. Where you are today, what you are today. I mean, you're in the family business play, and you know this. I mean, first generation builds, second generation spends, third generation destroys. So you're somewhere in the second to third generation. So it's what you have. It's industrializing the business, you know, rightly. So that's one challenge, you know, to have it.
Cool. We've got people queuing up and so on. But I wanted to just have this whole perspective, because we've been talking about the future and so on, but a real macro perspective from an absolute expert from our region. A big hand for Anthony, for him for joining us.
My pleasure.
And he's been very gracious to sort of come and work with us. And I think Anthony and Paul, you spent lunch together, but Vadia, who's ex-Etihad CFO, and others, I think Waleed and others, I think we need to start collaborating, because I think there are complementary components for both sides. I think it'll be a win-win. I look forward to that.
Thank you very much.
Anthony, thank you very much indeed.